the central bank, while it may be independent in terms of its monetary policy decision making, is really part of the consolidated government and part of the consolidated government's balance sheet. So the reserves, the surpluses that may sit on the balance sheet of a central bank, whether it's the RBI or the Fed or whatever, really do accrue to the government ultimately. So I don't think it's very productive to get too fixated on sort of trying to carve up that pie, because ultimately the pie does really belong to the government and to the taxpayer, because the central bank does as well. Central banks increasingly have been taking on additional roles, not just monetary policy, not just helping with fiscal debt management issues like that, government, the banker to the government, the banker to the banking system, but increasingly taking on roles in terms of financial stability and bank supervision, prompt corrective action measures, and the whole 9 yards. So in that context, the point I think I would really make is that perhaps a little bit unlike the narrow price stability target of monetary policy, these are issues that very much intersect and overlap with the broader economic policy interests of the government, and particularly in an economy like India, which is still very much a developing economy. Per capita GDP on a purchasing power parity basis is only a little above $7,000 in India. In China it's more like 16,000. In the US it's close to 60,000. So I think we have to be cognizant of the fact that India is still very much in the early to, let's say early stages of economic development. And so these issues of bank capital, of how you supervise the state banks, they also speak to issues of economic development policy as well as narrow financial stability. Well, I think they probably put a little bit less emphasis on emerging markets, because there is a recognition that the institutional frameworks and, as I just mentioned, the sort of policy priorities, the priorities over policy goals is somewhat different in developing markets. So I think there's a recognition that it's inevitable that the central bank and the government, the Treasury, will work quite closely together, and perhaps that line between the central bank and the rest of the government is not quite as bright as elsewhere. But more generally, in terms of rating agencies and perhaps other institutions, there is a fairly high degree of attention paid to the integrity of the policy framework, and that integrity does revolve to a certain extent around autonomy and independence. But I think it's more generally, is the framework robust? Is it working? Is it serving the interests of the national economy?